Would you like your IRA or other investments to earn more money? And would you like it to take less time? Let me introduce you to a type of investing you can do with your IRA where the returns are excellent, your funds are secured by real estate, and you can even help people. Best of all, you don't need to be rich already to participate. You can get started with as little as $15,000 to $20,000. I'm talking about investing in mortgage debt, or real estate notes as they're called. With notes, you can buy a borrower's mortgage and you become the bank. Don't worry if you don't know yet how to be anyone's bank. By the time this video ends in a few minutes, you'll understand exactly what we mean and how exciting it is. You can buy a note where borrowers are paying their mortgage every month. That's called a performing note. Or you can buy one where the borrowers have stopped making monthly payments. That's a non-performing or distressed note. Wait, what? Why would anybody buy a mortgage that no one is paying? We get that question a lot, so let me explain. Investors buy bad debts because when they choose the notes carefully, a win-win scenario can be created for the borrower and the investor. Here's how we buy non-performing distressed notes at a huge discount. In fact, we never pay more than 55% of the value of the house, and often we pay even less. So there's always home equity protecting our investment. Once we have the note, we can ask the borrower if they want to stay in the house. If they say yes, we can help them start making monthly payments again. Many people stop making payments due to temporary setbacks. Then their notes got sold, they don't even know who to pay, or we can modify their loans so they can afford their monthly payments easily. Once they're making their payments again, we can keep the note and get monthly cash flow, just like a landlord, but with a huge difference. If the toilet breaks or the roof springs a leak, no one calls us because we're not the landlord, we're the bank. Do you call your bank when your house has a problem? No, I didn't think so. If we don't want to keep a reperforming note, we can sell it for much more than we paid. How much more? A distressed note that can be bought for 50% of the home's value can normally be sold as a reperformer for 80% of the home's value. So a note that cost us $25,000 can sell after just 12 months of on-time payments for as much as $40,000. If the borrower doesn't want to stay, we can release them from the debt and help them move on with no further damage to their credit. In this case, we will take ownership of the house and can sell it or keep it as a rental. We can even sell it to someone who has a good stable income but can't get a bank loan. And we can be the bank for them. Now we're helping another family with their dream of home ownership. Let's look at some sample numbers that show just a few ways notes can be solid, high-performing investments. These are just samples to show you how note investing works. These are not returns we can guarantee, okay? That's an important point to keep in mind. Now ready? Let's look at some numbers. Say you had a house that's worth $50,000. The borrowers are supposed to be paying $500 a month, but they haven't paid in a few years. Keeping to our rule to pay 55% or less of the home's value, let's say we buy the note for 50% or $25,000. The first thing we do is ask the borrower if they want to stay and start paying again. If they do, we'll have them pay some money up front to cover some of the missed payments, and this is how it will look at the end of 1 year. Say the upfront money is $2,000. There are 12 monthly payments of $500, which equals $6,000. Add those two, and the total we've earned in 1 year is $8,000. We paid $25,000 for the note. That makes our return on investment, or ROI, 32%. That's great cash flow. And just imagine, we don't have to fix the house or be the landlord. Wow! We could keep the note and just keep collecting the borrower's payments plus some extra money each year to pay down the balance of their missed payments. This is a win-win for the borrower and for us. We get high ROI and the borrower gets back on track. But what if we want to get our cash back out of the note? Let's see what those numbers look like. Everything stays the same, but this time after 12 on-time payments from the borrower, we sell the note as a reperforming note. Remember, we collected $8,000 upfront in cash flow in the first year. Now we're selling the note. We bought it for 50% of the home's value, or $25,000, but we can sell it for 80% of the value, which is $40,000 because it's reperforming. Add the $8,000 and the $40,000, and that's our total income for this note. Subtract the $25,000 we paid for the note, and that gives us a total profit of $23,000. A return of $23,000 on an investment of $25,000 is 92% ROI. In this strategy, we almost doubled our money in just over a year. But what if the borrowers don't want to stay and start paying again, and we end up selling the house? This is what that looks like. The house is worth $50,000, but we'll sell it for $45,000 to get a quick sale. We figure our sales cost, realtor's fees, transfer taxes, etc. to be 10% of the sales price. That's $4,500. So we walk away from closing table with $40,500. Subtract the $25,000 that we paid for the note, and we get a total profit of $15,500. Our ROI in this case is 62%. Again, there's no guarantee, but this is how it can often work. Let's look at just one more scenario. This time we're selling the house, but we're going to be the bank for the new buyers. The house is worth $50,000, but we can sell at a premium price because we're saving our buyers all the normal cost of bank financing. Plus, we're giving them a chance to own a home even though they can't get a bank loan. So, say we sell the house for $60,000. They will put 10% down, or $6,000, and their payments at 10% interest for 30 years will be $474 a month. Our income for the first year will be their $6,000 down payment plus 12 months of payments of $474. That totals $11,688 and gives us an ROI of 47%. We got almost half our money back already, but look what happens after that. If this buyer was to stay and make all 360 payments of $474, the total they would pay over the life of the loan would be $170,640, meaning we turned the $25,000 we invested in this note into over $140,000. How many of those do you need for a happy, healthy, and wealthy retirement? But very few people stay in their homes for 30 years, so what if they sell or refinance in, let's say, 7 years? Take a look. Over 7 years, we've collected their down payment of $6,000 plus 84 monthly payments of $474. Our total collected is $45,816. In 7 years, we've gotten our $25,000 back and earned almost $21,000 on top of that. But here's the most amazing part. At the end of 7 years, the mortgage balance is still $51,063. And that's what we'll receive if they sell or refinance their house. Now we see again what's so great about being the bank. Additionally, if our borrower has a major medical problem or loses their job through no fault of their own, as the bank, can we be generous and give them a couple months break from payment to get caught up? Or give them a lower interest rate? Or reduce their unpaid balance when they pay us on time? Of course we can, and that's what's fun about being the bank too. We can make financing fit our borrowers' needs, and we can help them out. This is a great way to invest where we can earn phenomenal returns while changing lives for the better. Now we've talked about a lot, so let's recap. We looked at 4 exit strategies that all pay far better than average returns. The investment is secured by real estate. We can invest in notes using our IRA or savings, and unlike other kinds of real estate investing, you don't need a lot of money to get started. So, if note investing is right for you, call or email us and let's talk. Call Equity First Funding at 888-614-2111.